Brent Kesler joins me here today, and you could learn what his team is up to by going to themoneymultiplier.com. Themoneymultiplier.com. That's going to be a clickable link in the show notes, but really appreciate you joining me here again, Brent.
Yeah, Jack, glad to be with you, man.
So, we're going to just start things off. You visited me a good year ago, so this is going to be a good to catch up and just to revisit this topic. But let's start things off by telling everybody what is the money multiplier method.
Yeah, absolutely. So anyway, the money multiplier was kind of driven by a concept called the infinite banking concept. There's a guy that wrote a book called Becoming Your Own Banker. The guy that wrote the book is Nelson Nash. Nelson was my mentor. And actually, he passed away about 5.5 years ago in March of 2019 at age 87 years old. And I'm telling you, this book that he wrote called Becoming Your Own Banker, that completely changed my financial life. So that is a book that I definitely recommend that your community go out and that book, Becoming Your Own Banker, add that to your wealth building library because it is a game changer. And if you're like me and you have a little ADD or sometimes find it hard to read books, you can also get a couple hours of audio that comes with the book. Go find that book called Becoming Your Own Banker. So basically, the whole gist of the book is it's teaching you how to build, keep, and create wealth through your own debts and expenses that you already have by recycling and recapturing your money. So this infinite banking concept, it's not brand new by any means. It's been around for over 200 years. If you go out and look at what the wealthy do, for example, if you research the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, if you go out and see how Walt Disney built Disneyland, how Ray Kroc was able to fund McDonald's, right? How Pampered Chef got started before Warren Buffett bought Pampered Chef. So these are the tools of the wealthy, right? This is what they use to keep wealth in their family. Now, how do we do that? Just to give you the big 25,000-foot view. Now, before I tell you that, so like I have a full presentation that is on my website. So when your community goes to themoneymultiplier.com, there's a box on there they can click and it says watch Brent now. I have a full 90 plus minute presentation with all the examples, the handouts, right? All the numbers and exactly how the concept works. But just to give you the big overall view, is the concept is driven by using whole life insurance policies to build wealth. Now, I know I just said that nasty word, Jack, whole life insurance, and a whole bunch of people just turned off, out, right? Because they're like, whole life insurance to build wealth. That's a horrible idea. Why would I ever want to do that? That's not a good idea to build wealth because Dave Ramsey and Susie Orman told me it was a bad idea. Well, listen, if you have not just as far as just taking a look at this, you are totally missing because again, this is what the wealthy use. As a matter of fact, the number one purchasers of whole life insurance in the world are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. They have quadrupled their portfolio of how much life insurance they purchased in the last 10 years since 2014. So my question would be is why are banks buying so much in whole life insurance? Is it because they're stupid or they know something the rest of us don't know, right? So they know something the rest of us don't know. Now, I want to be clear. This is not any type of life insurance plan, all right? Right. So when people think of life insurance, they generally think of the first word that comes to their mind is death benefit. We are not designing this policy for the primary purpose of death benefit. Does it have a death benefit? Absolutely. That is the icing on the cherry on the icing, right? Yes, it does have a death benefit, but the way we design the policy is to where you have high immediate cash value. And when I say immediate, within 30 days. So all the life insurance that you hear out there, the term insurance, the variable insurance, the universal life, Index Universal, right? All those policies and stuff, that is not what this is. This is a specially designed, specifically engineered whole life insurance policy, which is in a mutual company, which is very important, that's designed for that high immediate cash value. In other words, this is not the life insurance policy that you will go buy from your brother in law that sells life insurance. I know it's not that type of policy. So, that is the vehicle that we're using to build wealth because because as all the dollars that you put into the policy, which is totally up to you, you decide how much money you want to put into your policy and how often you want to put that money in, whether it's monthly, quarterly, twice a year, annually. I have never told anybody how much money to put into their policy. You make the decision of how much you want to, how often you want to put it in, if you want to increase it, decrease it, it's completely up to you. And then we're going to take that policy, we're going to cash value of that policy, and we are going to use that money, Jack, to pay everything that we're paying in life, your debts, your expenses, your investments, any product and service that you're buying, you're going to use that money because when you let the money run through the policy first, you're now recycling and recapturing that money. That money is staying within a closed system. There's no money being leaked out to other people whatsoever.
So, just backing up there for a bit, you knew Mr. Nash directly, which is kind of a unique experience. I mean, he's
Yes.
your mentor. I was hoping you could spend just a moment talking about him as a person because
Oh my. Yeah, he's from Alabama, so he's got that twang accent, that Birmingham, Alabama, kind of that southern drawl, some of that southern hospitality, and I mean, right? So the majority of the time that I spent with him, it was with his wife, Mary, as well. And I mean, just great, great people. And actually, Nelson learned upon this concept, because back in the 1980s, he found himself about $500,000 in debt, owing creditors about a half a million dollars, and at 20 to 23, 24% interest, right? So, and the thing about Nelson, he was a very big man of faith, very big man of prayer. And he would always talk about before bedtime, he would get down on his knees and kneel before the bed. He would pray. And he talks about how at one particular time that he was about to get down and pray. And he's like, God, please help me find a way out of this financial mess that I've gotten myself into. He said, nobody else did this to me. I did it to myself. Help me find a way. And he talks about all of a sudden it was like a baseball bat hitting him across the eyes. And God spoke and said, Nelson, you have the answer right in front of you. You just don't see it. You don't see it, but it's right in front of you. So, what Nelson had done is he had spent lots of time, many years funding these whole life insurance policies, but he never realized how they actually worked, right? What you could actually, so he had significant cash value in these policies that he could obtain and he could get himself out of that debt. And that kind of led to the whole aspect of the infinite banking concept. Because as I said earlier, whole life insurance has been around for 200, 250 plus years. But now Nelson says, hey, man, this is a way that we can use the policy and we can help everybody to get the banker out of your life, right? If it was up to Nelson, nobody would do any business with conventional banks whatsoever, right? I mean, because again, the thing that we do when we do business with conventional banks, all we're doing is lining the pockets of the stockholders, the shareholders of those banks. Now, I'm not quite to that extreme. I still do business with conventional banks. I have to have a checking account basically. I got to be able to pay bills online or write checks and things like that. But the thing what Nelson was really talking about is like having to depend and rely on them to help get you through your financial mess and stuff. And there's a way that you can create your own banking system in your own life to where you never have to go outside and look, because the decision of whether you could take a loan or whether you could access money is a decision made by one person and one person only, and that's you, instead of relying on other people to tell you what they can do or what not do. I always remember Jack Nelson saying, Brent, it's all about the way you think. Don't let that crap get in your head. The mind is a powerful thing. It's all about the way that you think about things and the way you see things and what you can see. He talks about a law called Parkinson's law, which really means that you have to be able to learn to live off of less than what you make, right? You have to be able to break those bonds. You have to live off of less than what you make. And so many people in today's world don't do that, right? Because they've got credit card debt. They've got all this debt that's given to them, all this power to go out and spend money, but they really never think about how are they going to get out of this mess. And some of them don't get out of the mess, right? So he talks about it's how the way you think. He also talks about something else called the arrival syndrome. And the arrival syndrome, because this concept, the infinite banking concept, is a very outside of the box concept. It's not in the norm. It's not what your mom and dad are doing or your grandparents, friends, colleagues, or coworkers. It's not what your financial advisor is talking to you about or your CPA. It is an outside of the box concept. And so the thing he says is, he says, look, you always have to be open to receiving new knowledge, to receiving new information, right? And that's why I say all the time that so God gave us two ears and one mouth. That way we should be listening twice as much as we're talking. And he talks about that arrival syndrome, and he says, don't shut things out. Don't think that you know the answer to everything, right? So, like when I talk to you and I say life insurance, a lot of people would say, I know everything there is to know about life insurance. There's nothing new you can teach me. Okay. Don't be like that. Keep an open mind and just and take in what that other person is trying to communicate with you. I'm not saying it's right or that you have to agree with it, but at least keep an open mind and don't shut it out. Habits and behaviors, and it really has to do with your mind and how your mind works. And his whole just like basic meaning was to teach people how money really works. How does the money system, the monetary system really work, right? So he talks about that a lot. And then I wrote a book called Mapping Out the Millionaire Mystery. I wrote this book with a client who's now a colleague of mine, Chris Naugle. A lot of you guys may have heard of Chris Naugle. If you haven't, just go out there and go to chrisnaugle.com, especially if you're in the real estate industry. He's very active in the real estate industry. He had one show on House Hunters, another one on HGTV. There's one other, I can't think of the name right now, but just go Google Chris Naugle, watch what he puts out there, watch all of his information, all of his content. But anyway, this book, Jack, I will give to your community. All you got to do is go to the website. You can download the ebook, or if you want to send me an email, Brent at the Money Multiplier, Brent at the moneymultiplier.com. I'll send you that ebook version of that book, Mapping Out the Millionaire Mystery. If you really want to buy it, you can to get the hard copy. I guess go out to Amazon and get it. There's an audio version as well. But I always say, don't go buy it. I'll just send you the ebook version. Send me an email. You don't need to go out and buy it.
Well, there's a kind of a bit of a trick there too. Like I've gotten quite a few people sending me ebooks like that, and I consume a lot on my phone through the Kindle app. You can email those PDFs right to your Kindle app, so it's all in the library just like any other book. So it works actually quite well. So, in fact, if I think of it, I'll put a link in the show notes on how to do that. It makes it really kind of convenient. I'd be curious, with the infinite banking concept, you pointed out that book by Mr. Nash. How is your approach? You wrote a book yourself. What makes yours different from what he lays out in his?
Yeah, well, keep in mind, I mentioned his book quite a bit in my book. Back when he wrote that book, it was in the year 2000, 2000 or 2001. And I wrote mine just a few years ago. Out of all the books, the book that he wrote, this is the one you want to get. He did write two other books, He wrote one called The Case for IBC, and he also wrote a book called right here called Building Your Warehouse of Wealth. I suggest that you go find all of those books somewhere and get all three. But if all you can do is get one, get this one, the one that he wrote, Becoming Your Own Banker. So the answer to your question is that basically the thing that I did is I took 20 years more into the future of what he wrote. He wrote very good stuff, but that book allowed us to even use our imagination more. As I said, Nelson Nash always says, it's all about imagination. It's all about the way that you think. So the thing that we've done is we've taken the tools that Nelson taught us in his book and we've just expanded upon them. We've actually accelerated them. Like Nelson talks about when you start a life insurance policy, it's like planting an acorn tree. When is the best time to plant an acorn tree? 50 years ago. That's the best time, 50 years ago, to plant that tree. Now, the thing that we've discovered because of Nelson's teachings and how we can accelerate the concept and what he has taught. So you're really speeding up the time of how you use these policies. I'll give you an example. In his book, he talks about when you put money into the policy, you put money in the policy and you let it sit for 4 years, 5 years, 7 years before you ever start using it. Well, you don't need to do that. You're going to start using that money right away, immediately. Like, look, I'll just tell you, I invest in a lot of real estate and I even do more lending than I do buy properties. I do a lot of lending to people that buy real estate or that start real estate developments, and I am the lender. So I want my money to be moving quickly. So if I put some money away somewhere, I don't want it just to sit for a long period of time because I want to keep that money moving. I want to keep it in motion because I need to get that money working for me. Right. So I just had a guy, and I'll just give you an example right before I'm doing this call with you. There was a guy that paid me off on a loan. He paid $1.3 million. He paid this on November the 14th. And I'm like, okay, I got to get that money into another project because I was earning on that money, I was earning 18% interest. So $19,500 a month was coming in on that $1.3 million. Well, now that he paid it off, guess what happened? That 1.3 million, yes, it's back in my account, but it's not out there working. I'm no longer getting that 19. So I just called the guy that's starting another project. His name is Rob. And I said, Rob, we got to get this thing done. That money is just sitting there. It's been sitting there now for almost a month. I said, can we get this done where I can fund this new deal by Friday? Today we're talking, it's Wednesday. I said, Friday, can I go wire the money plus some additional money to get into the new deal so you get that money working, right? So as a lender, as even buying like as far as real estate, short-term rentals, long-term rentals, Airbnbs, VRBOs, I don't want the money sitting. I don't want it sitting. I want to keep it moving. And a lot of real estate people are like that. So that is probably the best thing ever is how we're using that money immediately. And my definition, anytime I talk about immediately is within 30 days. So that means I can go put dollars into a policy now, and within 30 days, I can now start using that money that I put in the policy, which is very, very powerful as far as how to buy cars and get all the money back. Right. And you're like, what? Buy cars and get all the money back? Well, most people, so here's how they buy a car. There's really only one of three ways a person can ever buy a car, right? The thing they have to do is they have cash. So they're either going to pay cash, they're going to bank finance it, or they're going to lease it. That's how they buy a car. Well, in all three of those scenarios, you have to give your money to the car dealer. The car dealer gives you the car. He's got the money, you get the car, the transaction stops, everybody goes home. But when you can add this one step into the process, add this one step by putting your money into the policy first, now you can recycle and recapture that money. So not only do you have the car that you bought, but you also get the money back. And guess what, Jack? If you can do that with a car, you can do it with anything, a boat, a bicycle, an airplane, a big screen TV, a chandelier, a piano, whatever it is. You're now turning every liability into an asset, every depreciating asset into an appreciating asset. So I show you in my book and on my And also on that 90-minute presentation I told you about on our website, themoneymultiplier.com, how to exactly do that. I break it down for you step by step of how to do it.
I just want to take a moment here and remind everybody to head over to themoneymultiplier.com. That is themoneymultiplier.com to take advantage of some of the resources that Brent has there for you. And if you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. And then I'm going to put you on the spot here, Brent. You
Uh-huh.
know, you kind of gave me an example. What, let's talk about this car as an example.
Yep.
I think it's really a great learning experience, and it kind of sticks with me if we could kind of go through the whole process there, the beginning to the end. Let's use the car as an example. Like, how does this actually work? First of all, we need to find somebody that even knows how to set these things up, because I guarantee you, if I go to my average insurance provider,
They
when I
won't know.
talk about this type of concept and whole life insurance and how I want to use it, it's dead in the water. Their eyes glass over. They don't have any concept of what I'm even talking about. So, can you kind of walk us through the process on how this whole thing works? We're going to fund this account,
Yep.
and and
Yep.
how do we interact with this insurance agency and
Yeah.
all that, everything
It
there?
exactly. So I'll give you the high level view. Just remember, I go into great detail with all the math on my presentation. But so here's what we're going to do. The thing we're going to do is just put money into an insurance policy. Okay. Let's just say you put in, say, $10,000 a year into the policy. Now, so the example I show is that at the end of the third year, you're going to go buy a $25,000 car. Now, you don't have to wait. Remember, you can start using your money immediately to go buy the car. So basically, you can put in $10,000 into the policy and you could essentially go out and buy an $8,000 car right away. So we put in 10 grand into the policy. We go buy a car for seven or $8,000. So what you just did with that $10,000 is you put the money in the policy. Now, you go take a loan from the general fund of the insurance company. Now, a lot of people think when you're borrowing the money, you're borrowing your money that you just put in there. No, you're not. And that's a good thing. Why is that a good thing? Because here's what you're doing. You're taking a loan from the general fund of the insurance company. All of your money in this example, all $10,000 is still in your account growing and it's earning interest, uninterrupted compound interest tax free with a guaranteed growth. It can never, ever, ever go down. It can only go up. Don't take my word for it. That's in the policy contract. Before you ever accept, sign, and pay for the policy, you will see that inside of the policy contract. So now the thing you're going to do is you're going to go out and you're going to buy that car. Okay, let's just call the car, let's just say it's going to be $7,500. Now, what you really should do, you don't have to do this, but what you should do is you should have a payment schedule to pay back the money that you just borrowed. Because guess what, Jack? If you go and you borrow money from a conventional bank, you're gonna have a payment schedule. You're gonna be sure you have a payment schedule, and you're not gonna skip a beat, because if you skip a beat, then you're gonna find yourself walking on your feet, because 'cause they're gonna come and get your car, right? So, the thing you should do is treat your money the same way you treat a bank's money. So, when you borrow from a bank, you pay them interest, don't even think anything about it. So, when you borrow from yourself, you should pay yourself back with interest, right? So now as you're paying that money back, all you're doing is you're just building that policy bigger and bigger and bigger. You're paying yourself back with interest, and those numbers keep rising every single year. Every day is better in a whole life insurance policy and a mutual company that pays dividend. Today's better than yesterday. Tomorrow's better than today. Again, that's in the policy contract. So now the thing you've done is now you are the own banker in your own life. You finance your own car and you're playing honest banker with yourself. Now, I know what people have. They say, well, my money, I'm not going to pay it back. I don't need to pay it back. Well, now all you're doing is cheating yourself, right? So because the more that you play honest banker with yourself, the bigger the numbers are going to get. I paid off $984,711 in debt in 39 months, 3 years and 3 months by using this process. I show you on that example. Okay, so on another example, when you watch my 90-minute video, I show you how a chiropractor from the state of Minnesota, that's the example I use, he paid off almost $470,000 of debt. He was only injecting 25,000 a year towards the debt, which would have been well more than 18 years to pay the debt off. He was injecting 25,000 a year of outside money, paid off almost $470,000 and did it in 61 months. 5 years and 1 month. He never worked harder, never changed his cash flow, never took any additional risk, or never lost control of his money. All he did is he put money into the policy. From the policy, he used that money to pay for these 12 third-party debts that he already had. He had already created the debt. He had already gotten himself into that situation where most people are in the situation where they owe something for whether it's good debt or bad debt, it doesn't matter. It's still debt. Well, how would you like to be able to pay that off in a way shorter amount? And then at the same time, all of the money that you're using to pay that off with is in an account that's continuing to build and compound tax free. And most importantly, in my mind, the government's completely out of your hair. See, here's what we all want to do, Jack. We all want to pay tax on our money one time only, at the lowest rate possible, get that money into a tax-free environment where it's growing tax-free and the government is completely out of our hair. So that's what we teach people how to do is build their financial wealth through their debts and expenses that they already have to break the bonds of financial slavery. The example I show in the presentation is putting 10,000 into the policy and buying a $25,000 car. And not only do we buy one, we buy a new car every 5 years, just like you probably do or your family. I mean, I want you to think about the car you're driving today. Is it the very first one you started driving when you were 16 or 17? No. The car you're driving today, is it the last one you're ever gonna drive? No, because those cars you've been driving, they wear out or you get tired of them, and the one you're driving now is eventually gonna wear out, you're gonna get tired of it. So we go through life and we buy and sell cars. Well, now I want you to think about this. How much of the money right now so do you have in your pocket from all of the cars you've ever bought, driven, and owned your whole entire life up to this point? Here's a hint. The answer is zero. So if I do nothing else but show you how to get part of the money or all of the money back on those cars, it's a pretty cool thing, right? There's a guy named Robert Kiyosaki, and in the real estate world, you know Robert Kiyosaki. He wrote a book called Rich Dad Poor Dad. He wrote another book called Second Chance. There's another guy named Tony Robbins. Tony Robbins wrote a book called Money Master the Game. In chapter 5 points, both of them teach exactly the stuff that I teach. They talk about in that book, they go over it in that book, exactly the concept I teach. Here's the problem with just with how they wrote the information in the book. They wrote the information in the book where it's very difficult and challenging to understand. And the layperson looks at it, glosses right over, and skips to the next line, the next chapter, and they really don't understand what they just read. I break this down into very simple fourth grade level so you can apply this in your financial life. I tell people all the time, I don't care if you make $10 an hour or $10,000 an hour. Everybody needs to break the bonds of financial slavery. They don't even realize they're in and start taking control of their own money.
You know, we Brent, every time you come on here and we say we're gonna talk 30 minutes, and then next thing you know, I have so many questions here that we could double that. However, I do wanna in the last few minutes we have, I do wanna spend a little time on a couple things that you mentioned. You said that we get to decide how much money to put in these accounts, and we can use this immediately. But let's be honest here. There's got to be a certain amount in there that makes it worthwhile. How much are we talking here? What would you recommend somebody start with?
Well, I'll tell you, out of the roughly around 17,000 clients that I have, The lowest client I think that I've ever seen start a policy is like $40 a month, and that's for a child. Our biggest client is, I believe, $40,000 a month. So you pick a number in between there. The policies work the same way for both of those clients I just told you. The only difference is you have more money or less money in one account than the other. So you have more money working. You have more money working the higher that you go. Now, yes, the person that's putting in $40 a month is not going to go right out there and take a policy loan. But people that put in, like I started my first policy at $2,000 a month. Now, I'll tell you, I think I have 28 policies now, and I do a little over $1 million a year in policy premium. And I add at least one policy every 1 to 2 years. So the first policy I started, I put in at $2,000 a month because I could not afford all 24,000 in one lump sum. So it's up to you how much you put in and how often you put it in, monthly, quarterly, twice a year, or annually. So typically, what people will do is when they start a policy, if they're wanting to use it right away, and most people do, 85% of the people are looking to start using that money within like 30 days. I would say 99% of them want to use it right away. Yeah. It's like typically what people will do is they'll think, okay, I've got this money anyway. I'm about to go put it into this real estate deal. But hang on. If I just add one step, if I take one additional step by putting the money in the policy first, and then from the policy, I'm going to use it to go fund the real estate deal, that makes a big difference because all that money is in the account compounding and you're using the money at the same time. So it really depends on how much money you need, and even if you need more than you're gonna put in, let's say you wanna go buy a house for $100,000, but you only have enough cash value to put into your policy to make it 25,000. That's okay. We just use the 25 that you have, and then you figure out the other way to get the 75. So it's not an all or nothing type deal. You can use a portion of the money to fund a portion of a project. You can say, "Oh, I got 25,000 in cash." Well, there's where 25 is coming. I'll figure out where else I'm gonna get the 75 from. But when you start doing this, Jack, you quickly realize you're like, "Crap, is this really working this good?" So now the thing that you quickly discover, come to us and say, "Hey, I'm not putting enough of my capital into the policy. I need to put more capital in so I can use more capital. So instead of me only funding 25% of the deal with policy money, I can fund 50, 70, 80, 90, or even 100% of the deal with policy money." Just like that loan. Just like that loan I told you about, that $1.3 million loan, and I think I have 19 loans out that equal $10.5 million as we speak today. Well, where did I get the money from? I took it from the cash value of the policy. So I took a policy loan from the general fund of the insurance company for the 1.3, funded the 1.3 deal. I got my 18% interest. I think that deal went for 10 months, that particular one. So for 10 months, I'm getting $19,500 a month. And now the money comes back. I could take the 1.3 and send it back to the policy. But I don't want to do that because now the money is sitting stagnant in the policy, which is not a bad thing, by the way. But if I have an opportunity to get that money out there and do another loan deal, right? I got this one guy, his name is Chris Rude. He does a lot of real estate. He's kind of famous for making trailer parks great again. That's kind of his tagline. He does a lot of trailer parks, right? So, okay, so Chris Rude calls me up, or I called him up last week. I said, "Chris, I've got a bunch of money sitting here. Do you have any deals? Do you have any deals? I've dealt with you for years. You're a great borrower. You're funding a lot of deals. I trust you. I know you, you know." So I just don't give anybody money. I don't give anybody loans. I always get first position lien collateral. As a matter of fact, Jack, I have a shirt, and the shirt says, "If you're not first, you're last." So I don't like being in second position, especially at 57 years old. I don't want to be in second position. I've been in second position in the past. I just don't want to do it anymore. I want to be in first position because if something happens to that deal, I can go after the collateral. I can go after the collateral that is securing that loan.
Well, I'm gonna direct everybody to your website again, themoneymultiplier.com. And you can imagine here, there's still a lot of content here that and resources you can find on the website. So head over to themoneymultiplier.com because we got a million different rabbit holes we could continue to go down here, including like in the end, how does this fund retirement? How do you start taking advantage of this money that's accumulating? There's a million different things that we could still discuss here. Um, However, we are unfortunately going to have to close out this episode and we're going to jump into our rapid fire questions. But before we do, Brent, is there a question or concept you think we should have tried to hit on today?
Yeah, well, I'll just say based on what you said there's a lot of different rabbit holes. Like when you go to our website, themoneymultiplier.com, yes, watch that full 90 plus minute video where it says watch Brent now. But I'll also say we have about another 70 videos that are way shorter, that are on the website. And I've already given you the resource, chrisnaugle.com, Naugle. Go watch everything he's doing. He's putting out Wealth Wednesday webinars. He's doing 4 or 5 live events every week. And he just pours into people, teaches about this concept. And then my daughter, Hannah, has a podcast called The Money Multiplier Podcast. She's got, I think, over 140 episodes out there now. She drops a new one every single week. Every single week. So The Money Multiplier, wherever you get your podcast, go watch her because she's putting a lot of content out there too. But yeah, you're right, Jack. There's a boatload of rabbit holes we can go down. And yes, we do show you how you use this in retirement. Anything that has to do with money, I bet you can find something that where we created a video on it. And if we haven't, ask us about it because if we can't find a video, we'll create one to answer that question in a video format. We love to do that. So if there's a question, any question at all that you have about wealth, building wealth, keeping wealth, about money, if there's not something out there that's been created, we'll create it for you. We'll create it. But we have tons of those videos. You could spend a couple weeks just going through all our content and material.
Oh, I really appreciate it, Brent. You always bring such great value to the show. But if you're ready, we'll jump into these and then we'll close things out.
All right, Jack, let's do it.
So, this first one is kind of fun. What lie do real estate investors sometimes tell themselves?
So, okay, so a lie, you said a lie.
Yeah.
Oh, well, I mean, a lot of times people will tell themselves, hey, um, and again, I've done this in the past where I come home and tell my wife, I said, honey, we got a great deal here. You know what? We can buy this property for 70,000. We can put in 20,000 to rehab it. And in 4 months to 6 months, I can sell it for 200,000. That is usually a lie. It usually doesn't work that way. There's a lot of more things that go on and that come up that happen that you're not expecting. And the more that you do this, the more that you do this, the more that you'll see and you'll start to learn from those pitfalls. You got to fall sometimes. It's okay to fall on your face and mess it up and be wrong. The most important thing is to get back up and do it again. It's just like the very first presentation, Jack, I ever gave on the money multiplier. I thought to myself, I'm totally nervous about how am I going to do this? What if I mess up? Well, guess what? Nobody knows that you mess up except for you. Your audience doesn't know that you mess up. I could have messed up 19 times a day, no idea. Only I know that I messed up. So just keep pushing forward.
If you could go back in time and give your younger self one piece of advice, what would it be?
Yeah, a couple things. Pay attention, get excited, and never quit. So pay attention to what's going on, get excited about what you're doing because if it's worthwhile doing, you might as well be excited about it and never ever quit. Don't give up. There's a guy that wrote a book, Jack Canfield, The Chicken Soup for the Chiropractic Soul. He told a story in there about a guy. He was making sales calls and all he needed to do was close 3 out of 100 calls and he got to call number 95 and he was 0. He was 0 for 95. But guess what? The next 5 calls, it was 4 out of 5, which totally it completely set him up for success. So you never know when that person says no. I always say, okay, it's all right, because some will, Some won't. So what? Someone else is waiting. Move on to the next person because you need to know. Let's say if your yes rate is only 10%, that means that you need nine no's to get to that one yes. So every time you get a no, you're one step closer to the success rate that you're looking for. And the other thing I would say is mindset, systems, and mentors. You got to have the mindset for what you're doing. Have a good system. And if you don't have a good system, find a system that you can work with and purchase that system or get involved with that system and a mentor. Everybody needs a mentor. We all need mentors, no matter how great we are at whatever we're doing. I like to go listen to stories of multimillionaires and billionaires. And the one common thing they always usually come back to, if you really dig, sometimes they don't tell you right away, but they have a mentor in their life that they are currently working with or have been working with. And if they don't have a mentor, they're looking for another one. Even the billionaires have mentors.
Do you have a book recommendation or what are you reading right now?
Yeah, a couple books that always come to my mind, and I've got quite right. So I've got quite a few of them. So back when I was a kid in school, I took this class. I never knew what it meant. I think I was in fifth or sixth grade. It was called I Can, two words, I Can, and all the books on that class were by Zig Ziglar. So Zig Ziglar, right? So, like, okay, that whole class was his course material. Now, I don't know who Zig Ziglar was in the fifth or sixth grade, but as I got older, I learned and I kind of kept and followed Zig Ziglar. So anything Zig Ziglar has out there, the late Zig Ziglar, and again, he says the one thing I live by every day of my life is, and I teach my kids this: help enough other people get what they want, and you end up getting what you want. So serve as many people as possible, and those fruits and rewards will come back to you. But a couple books here recently, a couple of them by Dan Sullivan, but were actually written by Ben Hardy. One is called it's called what, Who Not How. Who Not How is, I think, is a great book. And then there's another one called The Gap and the Gain. And that book, The Gap and the Gain, really woke me up because because I saw, even after, and I've had some pretty good success in my business life, but even after reading that book, I saw that I was in the gap a lot. I was living in the gap. I was living in the gap, and it's so easy to get into the gap, and you've got to have that mindset to get into the gain, or at least have that conscious awareness that, hey, I'm in the gap. I got to get into the gain. So yeah, who not how, and The Gap and the Gain, both, with, Dan Sullivan and Ben Hardy.
And then finally, what single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your
Well,
business?
yeah, you know what? I got a couple different answers, but I'm gonna tell you the one main thing, and I think COVID really helped us a lot because I was traveling around the country speaking at live events, 50 to 70 live events a year prior to COVID. Okay. That's what I did. I mean, I have my own airplane in the hangar, I have my own pilot. So I'm all around the country speaking. And that's what I did, live speaking events. And then guess what happened? COVID hits. And I told my wife, I said, honey, this is going to suck. Our business is going to tank because everything I do is live speaking events. So I was very nervous about what was going to happen. But guess what happened? Everything went to Zoom. Everything went to virtual. My business exploded in 2020, 2021, 22, 23, 24. We're big double digit growth every single year. And in 2020 and 2021, I didn't do speaking events. The last speaking event I did in 2020 was for an event called, it was out in Anaheim, California, for the Noteworthy event, Ben Fredericks and Aaron Halderman. And it was the last day of February, the first day of March. And then I left, I went to Idaho to go snowmobiling. And that's when COVID hit. And it was about at least 2 years before we did another live speaking event. But our business grew because of the internet, virtual podcast, things that we're doing now. So now I don't do near as many speaking events, but I do way many more podcasts. Today's the third podcast, and it's only, we started this at 1 o'clock Eastern time. I did a 90-minute seminar, another podcast, and you're the third one today. and there's one more today. But now I don't do them every day, but it's so easy, right? Because here I am, I put on my shirt, and I mean, I'm not going to show you the boxers I'm sitting here in. Okay? It's easy. You just get up, come to the computer and do it. So that was really, really helpful. And then I'll also say for businesses that need it, have a good software program or a tracking program where you can collect your, I think they call it CRM. I'm not a big technical, but with
Mhm.
that CRM, customer management.
Relationship management, yeah.
Yeah. So, and I will tell you, we use Infusionsoft over here, and it's worked out pretty good. So, but yeah, but probably by far is podcasts and virtual webinars. And now I don't have to pack a bag and stay in a hotel all the time. I still do. I love to speak on stage. I speak still on quite a few stages, but not near as many. Much more virtual events now.
Yeah, I'm gonna call out that the CRM. In fact, if you are an entrepreneur or a solopreneur that is looking for doing more with less, we're trying to squeeze out every minute of our day. Check out Real Deal CRM for that. It's realdealcrm.com. And I really appreciate your time again, Brent. This was fantastic as usual. I hope you'll come back again sometime because like I said, I have a page here of additional questions that I didn't get to as you were talking, and we could just go down a rabbit hole. So thank you so much again.
Hey, thank you so much for having me, Jack. I appreciate the ability to be able to share with your community. I know choices of guests you can invite, so I'm grateful that you gave me the opportunity. Thank you.
Yeah. Have a great one.
All right.